Brad Williams, Frugal Finance, futures markets, and how they work. This is a beginner's introduction to what the commodity/futures market looks like. Just an FYI, I used to be registered with the CFTC long ago. Future markets allow commodity producers and consumers to engage in hedging in order to limit the risk of losing money as commodity prices change. For example, a Kansas wheat farmer who plants a crop runs the risk of losing money if the price of wheat falls below harvest and sale. The farmer can minimize this risk by selling wheat future contracts, which guarantee that the farmer will receive a predetermined price. Hedging helps the economy function by allowing commodity producers, such as farmers, and consumers, such as millers, conduct their business with greater certainty over how much they can expect to earn from and pay for commodities. Future contracts. Future contracts typically are traded on organized exchanges that set standardized terms for the contract. For example, a farmer who wants to deliver wheat to a grain elevator near Topeka might find Chicago Board of Trade wheat future contracts useful for hedging, but would not want to make delivery on the contracts because the nearest CBOT delivery point is St. Louis. This is a technical issue that we'll touch on in a bit. Instead of making delivery, the farmer will buy back or offset the contracts before the delivery date and sell the wheat locally on the spot market. Most future contracts by volume are liquidated by offering and do not result in delivery. If you need additional information as it relates to how this works in detail, I have a webpage, frugalfinance.net, of a bunch of courses as it relates to the finance side of Frugal Finance. I have about 22 different courses. Well, we're talking about futures and forwards. Well, here's a course. It's $6. You have another course about interest rate futures or stock futures. Additional information, future value, and a whole bunch of other finance related, the quantitative side to the Frugal Finance. Very informative. The $5.99, look, that's just simply the cost to keep this website up and running. It's stuff that I used to delve into, and I put together courses, and they're very, very informative. Take a look. Anyway, back to the subject at hand. We have this farmer, and he's talking about delivery. Most future contracts by volume are liquidated by offsetting and do not result in delivery. I touch on this in detail. It is very complex, this delivery aspect. Take a look at my courses. Purpose of the delivery provisions is to ensure convergence between the future prices and the cash market price. Future contracts are different from forward contracts, which cannot be offset. If a purchaser buys a forward contract and sells an identical forward contract to a different person, the purchaser now has obligations under two contracts, one long and one short. Exchanges. Exchanges set standard contract terms, including the amount of the commodity to be delivered, the contract size, delivery month, the last trading day, the delivery locations, and acceptable, and here's what's critical, an acceptable quality of grade of the commodity. The exchange specifies that different varieties and grades can be delivered at various fixed differentials, premiums or discounts to the contract price. This standardization enhances liquidity by making it possible for large numbers of market participants to trade the same instrument. The liquidity makes the contract more useful for hedging, but standardization reduces the usefulness of a futures contract as a merchandising vehicle. Future trades made on an exchange are cleared through a clearinghouse, which acts as the buyer to all sellers and the seller to all buyers. When a future contract is bought or sold, it is technically bought from or sold to the clearinghouse rather than the party with whom the transaction was executed on the trading floor through an electronic trading platform. Since the contract is ultimately bought and sold from the same party, if a futures contract is bought and subsequently sold, the position has been offset and the contract is extinguished. Margin. This is what gets speculators into a whole heap of problems. You only need to put 10% down on a particular contract. 90% of that's leverage. Let me explain. Future traders are not required to pay the entire value of a contract. Instead, they are required to post a margin that is typically between 2 and 10% of the volume of the total value of the contract. Margins in the futures market are not down payments like stock margins, but are performance bonds designed to ensure that traders can meet their financial obligation. When a futures trader enters into a futures position, he or she is required to post initial margin of an amount specified by the exchange or clearinghouse. Thereafter, the position is marked to market daily. If the futures position loses value when the market moves against it, for example, you're buying and the market goes down, the amount of money in the margin account will decline accordingly. If the amount of margin in the margin account falls below the specified maintenance margin, which is set at a level less than or equal to the initial margin, the future trader will be required to post additional variation margin to bring the account up to the initial margin level. In other words, you will get called a margin call, and you're going to be forced to put additional equity, additional cash to cover that particular margin, or the exchange will sell out your position. Then they're going to come knocking at your door. On the other hand, if the position is profitable, the profits will be added to the margin account. Future commissions merchants often require their customers to maintain funds in their margin accounts that exceed the level specified by an exchange. Margin examples: suppose the initial and maintenance margin on a wheat contract are $650 per contract. Farmer who sells 10 contracts must deposit at least $6,500 with the clearinghouse through an FTM to cover the margin. Each day the position is marked to market. If the market moves in the farmer's favor, the future price declines on a particular day, the farmer's margin account is credited with the accrued profit for that day. If the future price rises, the margin account is debited with the accrued loss. On any day when the margin account falls below $6,500, the farmer is required to post variation margin to bring the account back up to at least $6,500. Hedging example: a CBOT contract provides for delivery of 5,000 bushels of wheat in Chicago. A farmer plants wheat during the spring with an expected harvest of 50,000 bushels. Currently, the CBOT contract for delivery during December, the first new crop contract month for spring wheat, is trading at $3.50 per bushel. The farmer knows that he or she can earn a reasonable profit at $3.50 per bushel. By planning, farmers effectively long, betting that the price of wheat will not decline before sale. The farmer can hedge this bet by establishing a short futures position at the current price of $3.50 per bushel. Since each futures contract provides for delivery of 5,000 bushels and the expected harvest is 50,000 bushels, the farmer would sell 10 futures contracts. At harvest, the weather has been ideal and the farmer harvests 50,000 bushels of wheat. In fact, there's been a bumper crop and the price of wheat has declined to $3 per bushel. The farmer now has 50,000 bushels in his silo and is short 50,000 bushels on the futures market. The farmer now needs to get out of this hedge position. There are two ways to accomplish this. One way is to make delivery pursuant to the terms of the 10 futures contracts at a specified delivery location during the delivery period. However, delivery would require paying to transport the wheat to one of the locations specified in the futures contract, which would be cost prohibitive, from Kansas. The farmer is better off taking an equal and opposite position in the futures market by buying 10 contracts at the current price of $3 per bushel. So he's guaranteed that $3.50 per bushel. He lost on the harvest. But he made on the short position. So he's going to net $3.50 either way. If he didn't short his crop, he would have lost 50 cents per bushel. That's the beauty of hedging. Now, if you're a speculator, we'll get into that in another discussion. That's a whole different variety. That's a whole different strategy. This is just a quick introduction of futures markets and how they work. Comment. Let me know if you have any follow-up questions. Let me know if you're a trader. If you have any secrets. Share some insight for beginners. Warn them about the risks of speculating. Throw around maybe some hedging ideas. Anyway, Brad Williams, Frugal Finance. Thanks for watching. See you soon.